Welcome back to the Neuro Finance Masterclass. I'm Ibrahim, and my co-host and I are absolutely thrilled to kick things off today because we are officially hitting a massive milestone, day 97 of our 365 Days to Financial Freedom series. Over the last 96 days, we've been building a rock-solid foundation together, but today we are unlocking a completely different level of market mastery. Today's theme is Seasonality and Market Cycles, the Architect's Calendar. If you're tired of guessing and you want to start actually anticipating the market, you are in the exact right place.
So here is the roadmap for today's explainer. We are going to decode the 4 distinct cycles of time that govern the financial markets. We'll cover the missing dimension, the Bitcoin halving cycle, stock market seasonality, and macro market cycles. Finally, we'll wrap it all up by building your personal architect's schedule.
All right, let's jump right in. Section 1, the missing dimension, time, the 4th dimension of markets. Look, amateurs are completely obsessed with the where, the price, and the what, which is the volume. They're constantly chasing the market, always reacting to whatever just happened. But elite architects, we focus proactively on the when. Time is literally the missing dimension for most investors out there. Mastering it is what lets you position yourself way before the crowd even realizes the weather is changing.
Think of a true architect like a master farmer. You wouldn't just walk out into a frozen field in the dead of winter and try to plant seeds, right? That would be ridiculous. Well, financial markets have those exact same predictable temporal cycles. It's just a fundamental law of nature and economics. An architect never fights the market seasons, they prepare for them.
Moving right along to Section 2, the Bitcoin Halving Cycle, the 4-year rhythm of digital assets.
210,000. That is the magic number. If you cast your mind back to day 91 of our series, you'll remember this is the precise moment the supply of newly minted Bitcoin gets chopped right in half. Every 210,000 blocks, we experience a programmed supply shock. It is not random at all. It's hard-coded math. And that mathematical certainty, that's the heartbeat driving the entire cryptocurrency market cycle.
So let's actually trace that chronological flow. Day 0 is the halving itself. From there, we step into an incubation period, usually lasting roughly 12 to 18 months. Historically, that supply shock eventually ignites a massive bull market expansion, right around months 18 to 24. And then, we hit years 3 and 4, which everyone calls the crypto winter. Now, amateurs completely panic here, but an architect, we know the internal clock is simply recharging for the next expansion phase. It's entirely predictable.
Which brings us to a core philosophy that, honestly, you should probably pin to your wall. We don't trade the daily noise, we trade the 4-year supply rhythm. When you zoom out and ride this macro-temporal wave, those daily red and green candles just lose all their emotional grip on you. You stop getting caught off guard by short-term volatility because your perspective is finally anchored to a massive, underlying structural reality.
All right, shifting gears from crypto to traditional finance for Section 3, stock market seasonality, the traditional calendar. Wall Street has this famous old adage, sell in May and go away. And the data backs it up. From May to October, the markets historically just kind of drag, dealing with sluggish underperformance. But then you look at November to April, hello, Santa Claus season. That stretch historically delivers the absolute strongest gains, often capped off by a massive rally right in late December. Guys, these aren't just myths, they are statistical probabilities showing up year after year.
But why exactly does this seasonal rally happen? It's definitely not magic. Just like we discussed on day 80, it boils down to institutional realities. You've got massive institutional tax planning, a huge flood of cash from year-end bonuses, and corporate rebalancing all colliding at the exact same time. It's a structural liquidity event. An architect uses these historical probabilities to perfectly time and adjust the dollar-cost averaging, or DCA machine, that we built together back on day 69.
Okay, let's go even bigger. Section 4, presidential and business cycles, surfing the macro waves.
We can methodically break down the business cycle into 4 distinct phases: expansion, peak, recession, and trough. Now, everyday retail investors are absolutely terrified of step 3, the recession. But an architect knows a recession is literally just the market breathing out. You can't inhale forever. When you know that a peak naturally leads to a recession and a trough naturally leads right back to an expansion, fear is replaced by calculated strategy. Zooming in on the U.S. presidential cycle, the magic number to remember here is 3. Historically speaking, the 3rd year of a presidential term is the strongest year for the stock market.
Why? Because administrations have historical tendencies towards stimulative economic policies right ahead of an election year. And just to be clear, we aren't taking any political sides here. It is simply a highly predictable macro wave that you can position your portfolio to capture.
The crucial takeaway here is super simple. Stop swimming against the current and start surfing with the giants. When you align your portfolio with these massive macro-temporal waves, whether it's the 4-year Bitcoin cycle, annual market seasonality, or the presidential cycle, literally everything changes. Investing stops feeling like this grueling uphill battle and starts feeling like you're riding a wave of inevitable momentum.
Which brings us to our final takeaway. Section 5, the Architect's Schedule. This is your cognitive task for today.
You have to stop treating every single day like it's exactly the same. So here's your task today. Pull up a 10-year monthly returns heat map for Bitcoin or the S&P 500, whatever you prefer. Look closely at the raw data. I want you to identify which months are historically red and which are historically green. You'll start to see the seasonal patterns just leap right off the page at you. And once you see it, you can't unsee it.
Bringing it all back to our farmer metaphor from the beginning of this explainer, true financial freedom requires knowing exactly what season you are in. You must categorize your year. There are planting months, which are historically red periods meant for accumulating assets at a deep discount. And there are harvesting months, which are historically green periods meant for taking your hard-earned profits off the table. You accumulate in the summer lull and the crypto winter, and you harvest in the Claus Rally and the post-halving bull run. Take a moment to really let that sink into your strategy.
So, I leave you with this one provocative question to ponder today. Which months are your green months, or are you still out there trying to plant seeds in the winter? It is time to master the calendar, respect the seasons, and truly rule the cycle. Thank you so much for joining us for day 97 of this masterclass. Go do your homework, study those heat maps, and we will see you right back here tomorrow for day 98.